You were just a very special guest at the FX Summit. Can you walk through kind of your experience there?
I loved it. I had such a great time. I think you have something really special there. It's totally different from anything I've been to anytime recently. It's really great.
All right, welcome back, ladies and gentlemen. We have a very special podcast. The man, the myth, the legend, Mr. Bob Elliott joined us again. Bob, welcome back to the show.
Thanks for having me. It's exciting to be here.
Before we kick it off, you were just a very special guest at the FX Summit. Can you walk through kind of your experience there? What did you think about the overall event?
I mean, I had such a great time there. I think, if you're in the institutional finance world, you spend all of your time, rubbing elbows with the same people and the same types of people from, who are the coastal elites, let's say. And the thing that was it was so refreshing, frankly, to come into a room where the energy, the passion, the excitement about, learning about markets, learning about trading, and frankly, a room that, reflected America, was a good reflection of the whole investment community, anyone, and the accessibility of the investment community. And so I loved it. I had such a great time. The people who were there were so smart and passionate and driven and just looking to pick up understanding, and that sort of openness to learning is just such a great environment to create. So I think you have something really special there. It's totally different from anything I've been to anytime recently. It's really great.
It's a relief to hear that. Everybody really enjoyed your talk. And I know we kind of got technical on the talk, but I think that's what people were really craving, is that experience and that just sort of that just all the value that you brought. So really appreciate you making time for us. Let's jump right into the sauce that people really, really are interested in.
All righty.
What do you think about the current state of the U.S. economy?
Well, I mean, you give me the softball to open up here. I think we're in a position here where there has been some. We're still in an inflationary late cycle environment. That's definitely true. And I understand, when people search for and look at maybe the most recent CPI stat and the most recent experience there, they might be holding on hope, really holding on hope that it's not an inflationary late cycle environment, but that it's a soft landing and a rebound for the future. And I think, the way I've described that is, it's possible we have a soft landing. That's not unheard of. It's not a total impossibility, but it's a pretty low probability event. And I think that's really, when you're trading markets, what you're thinking about at any point in time is, what is the probability of an outcome relative to how much that probability is priced in. And so when I look at the market today, what I see is there's more conviction around the possibility of a soft landing and the probabilities of a soft landing than would make sense if you reflect on the history of inflationary periods and how they're typically resolved. And there's there's very little weighting basically anywhere on the probability of inflation persistence, which needs to be met with essentially an eventual hard landing. And so that's kind of when I'm looking at the market, that's kind of the dynamic that I'm seeing. And I think in part what's exacerbating that is that the Fed in particular is remaining a few steps behind. And because they're remaining a few steps behind, they're enticing additional risk taking, which is essentially increasing the probability of how a soft landing is being priced in, right? You have stocks that, stocks go up every day is what it seems like in the last 8 weeks or so. Every day come in and it's up, and that is not the sort of dynamic that typically would occur in a late cycle environment if the Fed was ahead of the curve and slowing down the economy. So that's kind of where we are. Like, those sort of probabilities and exactly how this is going to play out, I think there's still a lot of uncertainty, and maybe I should just layer that on top of everything is, it's still uncertain about how this is all going to play out, but it really does look like people are overpricing the likelihood of soft landing and underpricing the probability of, stickier inflation, higher for longer, and a more challenging environment to bring that inflation durably down.
That's kind of what it seems like, is that markets are sort of getting ahead of themselves. But there's a lot to unpack here. I kind of wanted to go piece by piece. When we're looking at these things, and you said that we kind of need to look back at historical context. What historical context can you really point to that resembles the time that we're in right now?
I think there's a lot of instances where you see environments where there's a supply shock of some sort. In this case, it was, the COVID-related supply disruptions, which create inflationary pressures and inflationary impulse into an economy. And of course, that was also exacerbated by the Ukraine war. So you sort of had like a twofold inflationary impulse. And then basically what happens in terms of how that plays out through to the rest of the economy. And I think if you just sort of take that circumstance, there's a lot of cases, dozens of cases in the developed world over the course of the last, 75 years that have that shape and that form. And of course, in certain circumstances, the initial inflationary impulse was bigger. In certain cases, the level of underlying inflation was higher. But it's important in this sort of situation, abstract a little bit from the particulars of exactly how high inflation was and stuff. Like, I agree. If someone shows me a chart of the 70s and says, doesn't it just look like 1979? Like, no, it does not look like 1979. Like, we're not even close to what 1979 looks like. But what you can draw from those experiences is the cause effect linkages and the way the dynamics work, even though the elasticities or the levels or the magnitudes are a little smaller. And so I think that's really what I'm drawing on, is that history of, dozens of cases like that over the last 75 years.
I was going to save this question till later, but do you feel like the fact that we're kind of in the late stages of the larger economic cycle, do you feel like that has any implications in any of the decisions that we're making now? Or are we still kind of, is that process just so drawn out that we have time and they're not really related?
Yeah. Well, I think the late cycleness is actually, when you think about how these dynamics work, like, you want to understand the magnitude of the inflationary impulse and then how it's flowing through to other prices in the economy. And each economy is different. And so, for instance, like, the inflationary impulse in the UK was larger in magnitude, and many of the prices are more connected fundamentally. Many of the other prices in the economy are connected more fundamentally to that inflationary impulse, versus, say, the US, where the inflationary impulse was mostly, in certain discretionary goods and then in oil very specifically, and lots of the stuff we don't spend on, we spend on, like services. We didn't see that initial impulse. So you gotta think about it that way, but then you want to think about it in the context of where you are in the cycle, because where you are in the cycle determines the likelihood that labor has the ability to negotiate for higher wages in response to that inflationary impulse. And so what we've seen is actually very normal, which is inflation comes in, real wages fall. And to be clear, real wages today are lower than they were in 2020, right? Real wages are down. And so then what happens is, can people negotiate higher wages comes down to, is the economy in a later cycle environment? Is the labor market tight? And the answer to that question in this case is yes, the labor market is tight, which is why what we're seeing is we're seeing wage growth, nominal wage growth, going at 5 or 6%. And that is a function of the fact that people have been able to negotiate higher wages. I was just before we started, I was looking at the Atlanta Fed wage tracker, which is the best sort of comprehensive source on wages for a variety of reasons. And what it was showing was that, wage growth, nominal wage growth, has come down a little bit from peak, which is kind of what you'd expect. I mean, conditions have softened just a touch and the wage and inflation pressures have softened. But what you're seeing is, for a while, it was only job switchers that got meaningful upgrades in their wages. But now you're seeing job switchers and job stayers getting the same amount of wage growth. And that's a perfect example. Those are the stages of the inflationary dynamic flowing through, which is, first, an impulse, negative real wages, then people who are switching jobs to negotiate for higher wages, then people who have who are staying in their job have the ability to negotiate for higher wages, right? And that's sort of the permeation of the inflationary pressure through the economy, which is really a function of how tight labor markets are.
For sure. So, I mean, it's only possible for the labor market to negotiate for higher wages if there's scarcity in the labor market. If you can't find more people to come take the job, you're going to have to meet the demands of the people that are working. Does that mean that there's not that many people that are available in the labor force?
Well, regular readers of my Twitter will find me every week posting that that it's a weekly reminder that the U.S. labor market remains secularly tight, and for exactly that reason, which is, I think, one part of the circumstance. People will look at this current conditions and they'll say, growth is like kind of soft, like it's not like we're booming in real growth, right? And they'll say, well, it doesn't seem like, how could labor markets be so tight when real growth is kind of modest, like 2%, right? It's not that extreme in terms of growth. And a big reason why that is because labor force growth has radically changed relative to previous cycles. So if you go back to the 2008 cycle or the 2000 cycle, we had labor force growth that was running 1-2%, and then add on top of it productivity growth that was 1 or 2%, and you saw sort of a normal GDP growth of like 4, right? That was kind of normal, and then add on 2% inflation, you get 6% nominal growth. That was normal growth back in 2000 and the 1990s. Well, today labor force growth is running, frankly, not that much. It's like running at 0.5% annually, because we have the baby boomers retiring, plus excess retirements that occurred during COVID. We have productivity growth in the economy that's close to zero. It's a bit of a question of exactly why it's so soft, but it has been that soft for almost 15 years following the financial crisis. And then, so you add those two things together and you have essentially 0.5% labor force growth, zero productivity growth. Well, a neutral rate of growth in the economy is, a lot closer to 1% than it is to 4% today. And so it just doesn't take that much demand in the economy to lead to a tightening of labor market conditions. And so that's why we're seeing what feels like slow growth, but also tight labor markets. Those are two things that are occurring simultaneously. And that's a very interesting dynamic that most people have never experienced.
Yeah, it's a little tough to kind of put those pieces together, but I do want to go in order here just to make sure that we're kind of hitting all the pieces. The goalpost for what seems to be a soft landing keeps changing. And so at first it was the Federal Reserve basically doing a full pivot, and then it became just sort of reducing the aggressiveness of how fast they were going, and then it was just so where's the goalpost?
Not hiking anymore, right?
Yeah, for sure.
Well, so what's a soft landing? It's a good question. What's a soft landing? I mean, a soft landing is essentially an environment where inflation comes down durably to the Fed's target, or close to the Fed's target, in an environment where we don't see a substantial loosening of the labor market, a substantial rise in the unemployment rate. That's really what I think, the essence of a soft landing is. That people are thinking about when they're thinking about that.
So if you take into account a tight labor market, and I know we don't want to put too much weight on it, but the recent CPI report to show that we went from 4% to 3%, doesn't that meet the definition of a soft landing?
Well, I think the question, the key part of that is durably, right? Have we durably achieved inflation at or near the Fed's target? And I'll remind you that, like, if you go back to the 70s environment, Arthur Burns got inflation down to 2%, to under 3%, got it down not that far from what looked like there was an explicit mandate, but close to 2%, and then started to ease aggressively in response. And what did we see happen? We saw a re-acceleration of inflation that happened over a few years. And that was before the subsequent oil shock that happened later in the 70s. And so, like, the question is not one print that's low. Like that's not what we're trying to do here, right? And I think it's important to recognize that's also not, the Fed is smart enough to recognize that like one print does not matter. Like if you read Twitter yesterday after yesterday's print, you'd think like, the inflation fight is totally over and we're never going to think about inflation again. We're a long way from that. Like, we'll prove the soft landing when inflation is 2% for 6 or 12 months. Core inflation is 2% for 6 or 12 months, and the labor market remains relatively tight. That's what a soft landing looks like, and it sure seems like we're quite a ways away from that. The probability that we'll end there, because we still have that tight labor market, high nominal wage growth powering continued spending in an environment of very weak productivity growth. And so that, until that gets solved, it's hard to see a circumstance where you get the true soft landing.
I really appreciate that, kind of getting us back from the day-to-day and sort of like the shorter time frame price movements over to the macro, which much appreciated. Do you feel like any of the reality of these dynamics matter to the markets, or because the markets seem to be pricing in a soft landing, and as long as the markets believe that there's a soft landing, is there a chance that this run could continue and that optimism could continue to lead to some growth, or is there a chance that this comes crashing back down?
Well, I think this is one of the things that the soft landing crowd like always seems to forget. They're often thinking on a first order basis. It's like, okay, so maybe we do have a soft landing or a softish landing that we're moving towards, where inflation is low and growth is strong. Okay, well, what will happen in that circumstance? Well, what will happen is growth will remain above potential. Labor markets will continue to tighten. Capacity in the economy will continue to tighten. Stocks will continue to rise, right? And what will we have? We'll have more bonds. Bond yields will go down, right? Those are all indicate, and that's basically what we've seen, like in the last 48 hours. Not to get too timely on it, but that's essentially what we've seen. Stocks up, bond yields down. We've seen that for the course of the last week or so. But what people forget is that is stimulative, right? And so what you have is you have an outcome which by its nature is stimulating the economy. The fact that stocks keep going up, the fact that bond yields are falling, helps support cyclically sensitive sectors. It helps support balance sheets. Well, what happens when that happens? It means we're going to start to spend more. What happens if we start to spend more? Well, then the economy continues to tighten. And in many ways, that pricing in of the soft landing, increasingly pricing it in, actually sows the seeds for the failure of the soft landing, because it creates the reacceleration of the economy that makes a soft landing not able to be durably in place.
Wow. So what would be the biggest factors that you could see leading to a resurgence in inflation? Because I know you mentioned wage inflation. Do you feel like that's a pressure that could lead to some stickiness long term?
Yeah, I mean, I think the wage inflation dynamic is persistent, and so you can kind of think about that like as a grinding cost on prices, on particularly on services prices. Like any small business owner who's hiring any folks working in the service economy knows that pain, that services prices are, services costs, wage costs are elevated, and they're sitting there thinking about, how do I pass that along to my customers, as effectively as possible. I think the real, sort of outlier, like if you think about what has driven the real disinflation, that move from 9 to 3, the decline in gas prices from $5 a gallon to $3 a gallon has been a huge driver of that. Probably 75% of the driver of that disinflation that we've seen. And so I thought it was particularly interesting on the day that the soft CPI number came out. What did we see? Well, we saw oil prices up a few bucks, and that, again, talk about sowing the seeds for the reversal. Well, okay, if oil prices go up 10, 20, 30% from here, which would not be unusual or even extreme, right? And we see oil prices starting to rise again. Well, because economic activity is strong and because asset prices are lifting, well, that is the inflationary pressure coming back into the economy. And so that's really what you have to watch out for. I could easily see a circumstance where we see this, pressure, upward pressure on oil flowing through to gas prices and creating a bump back up around that sort of structural dynamic that exists in the economy.
That's fascinating, because we have seen core CPI continuing to stay elevated while CPI is starting to come down. So that shows that all it takes is one crack.
That's right.
With either food or energy to sort of really bring back inflation, right?
That's right. On the upside, like, the rejoicing is happening, and I'm looking around and saying, okay, so are gas prices going to $1.50? Because that's essentially what you have to bet on to have inflation at this level be persistent, right? You have to have gas prices keep falling in such a significant way in order to keep prices, the growth of prices low. And that, that seems improbable. It's not impossible, but it seems improbable that we'll move that way. And frankly, the intermarket action really looks, again, geared towards a reflation, which is problematic if you're betting on that soft landing.
We've gotten way off script, but just on that note,
I always seem to do that to you.
No, because you make so many great points. It's hard to just like leave that point and be like, okay, thank you for all those. Let's go move on to this other thing I want to talk about. Like, no, let's hit on these real quick, because these are pretty important points. We do typically see, especially around election cycles, gas prices typically don't balloon, because there are certain measures that the executive can take in order to alleviate gas prices, which makes the sentiment overall a lot better. Is there a chance that we see a dynamic like this leading into the elections, where the economy is not falling apart, but we're not really making any improvements in real GDP, but we just basically skate until the election?
Yeah, I mean, it's the tactical management of the economy around elections is certainly something that can sort of nudge the economy in one direction or another. I think on the inflation side, we have seen essentially a cutting in half of the strategic petroleum reserve through the administration's actions to bring oil prices from 5 to 3. And so, could that be used in order to further put a lid on gas prices in the run up towards an election? It's certainly possible. Now, I think people who are smarter than me on this topic will come back and start to say, well, there are actually physical limitations in terms of how much you can draw down the SPR related to storage and sludge and structural integrity of the tanks and things like that. It's good. I'm glad those people are out there thinking carefully about this stuff. The gist of which is, it's unlikely, given the amount of drawdowns in stocks that we've seen, both in Asia, which is a whole different story, but basically you've seen a reasonable amount of drawdown in stocks there, plus the drawdown in the SPR. There's not a lot of additional capacity in the system to release more supply in an environment where we start to see that upward pressure on gas prices. So, that option, which was it was critical to take, 500,000 or 1 million barrels off the market, or supply 500,000 to 1 million barrels into the market when gas prices were elevated. Unlikely that we'll see that again. So we'll see probably much more market-driven dynamic coming into the election cycle.
God, I hope so. I hope you're right, Bob. So this has kind of become a running meme, and I asked you about this on stage. I've talked about this on Twitter, but you speak about the labor market pretty regularly, and you mentioned that the labor market is secularly tight. What do you mean by secularly tight?
Yeah, for sure. When you think about any economy, I like to break it down. There's basically like 3 different sort of pieces. There's the business cycle, and we kind of all know the business cycle if you've been around thinking about macro a little bit, 5 to 7 years, kind of goes like this, around. Then there are long-term debt cycles, which are, long-term in nature, 30, 50, 75 years. And then what I like to say is sort of the secular trend in the economy, right? And that has to do with productivity and labor force growth and things like that. And so when you're thinking about secular trends, what you're really talking about is multi-cycle trends, things that are extreme on maybe a 20, 30, 40, 75-year basis. And so when we look, for instance, in a very simple way, the unemployment rate where it is today is basically at 50-year lows. That's a secularly low situation. It's a secularly low dynamic in terms of the unemployment rate. But it's not just that. Like, unemployment rate can be a little goofy. You could look at, for instance, prime age workers as a percent of the total prime age population. That's at 30-year highs. That percentage is at 30-year highs. Again, high, basically at the peaks of the 2000 cycle, higher than 2008, higher than 2020. That's kind of the thing that we're talking about, is at multi-cycle highs. I could eliminate secular and call it just multi-cycle highs.
but that would add way too many syllables. So
yeah, I couldn't write that many characters on Twitter. That's why I gotta keep it tight.
All right, so if we're going to talk about the secularly tight labor market, you said 50-year lows in unemployment. What do you think is contributing to such a tight labor market?
Well, I think a big part of it is that that we have a pretty significant evolution in terms of the labor force in the U.S. In the 2008 cycle, most of the baby boomers were right on the edge of retirement. Right, maybe they were 5 years away from retirement, and I have sort of a firsthand view of this. My parents were born in 47, so they were essentially the earliest of the baby boomers. So I see that very directly. And so in that cycle, they were still in the labor force. And then, as we look at this cycle, they're long retired. And I think that story is really what we're seeing throughout, is that we have that demographic shift where a lot of those older workers are coming out of the market. In addition, and it's a pretty important addition, retirements accelerated during COVID in a way that also has taken out 1 or 2 million more additional people. That's about 1% of the overall labor force. Doesn't sound like 1%, doesn't sound like that much, but if the unemployment rate was 4.5 instead of 3.5, that would be a pretty big deal, right? And those early retirements, you could talk a lot about why that is, but the gist of which being, many people have speculated that it's related to like COVID changed people's priorities, changed the way they were thinking. It also, the strong asset price environment was also beneficial, because many of those folks retired with elevated assets in place, because stocks are way above where they were pre-COVID, houses are way above where they were pre-COVID, and so they had the balance sheet to be able to do that. The last thing I'd mention is, we shouldn't forget that there has been a reasonable amount of sickness-related loss of productive capacity in the economy that was related to COVID. Not just the deaths, which obviously were terrible, but long COVID is a real thing and has meaningfully influenced, we're talking millions of workers. It's a little harder to quite quantify in any specificity, but if you think about it, like 1 to 2 million workers early retired, you have some number of folks who a lot of, we had deaths, which is a real thing amongst the productive parts of the economy. And then we also have this long COVID situation. You sort of add that all up, and there's sort of this like weight that's even bigger than the demographic shift, which would be meaningful even on its own.
Wow. The level of nuance in there is so important, because everybody has an anecdotal, like everyone who listens to that is going to have some kind of anecdotal experience that says, yeah, I have a family member that actually did leave work early. It's actually really fascinating. If you compound that on a massive scale, how much of an
you're talking about literally millions of people who would otherwise be in the workforce who are out, and that's creating the tightness. That's all there is to it.
So I do want to stay on the labor market here for just a second. There's a lot of different components when you're looking at the labor landscape. There's the JOLTS report, there's the quits rate, and there's some of these different, there's all these different components. Is there anything that's standing out to you right now as a little bit odd, or something that just seems misplaced?
Yeah, well, I think the thing, there's a lot of data, and actually, that's part of the benefit of labor market data, is we really get to see it from a lot of different angles. So, part of my inclination related to employment data is you want to look at everything and kind of get that pointillist picture of what's going on. So, whether it's layoff announcements or, initial claims, which I write about on a weekly basis, or the employment report, which has 2 different surveys, right? You've got a wealth, JOLTS is another one. You've got a wealth of these different pieces of information that you could sort of triangulate the general picture, right? And that I think is when you're thinking about macro in general, I think that's a really good lesson, because let me tell you, and you can always find data that supports a very positive conclusion or a very negative conclusion. There's no question about that. And let me tell you, Twitter is filled with people who have selected specific data that support a particular direction or set of views. And really, the right way to do it is to look at the totality of the different pieces of information and kind of try and synthesize, like, probabilistically, where are we given all of this information? Does it look good? Does it look bad? Does it look kind of neutral? And kind of balance all those different things. The one piece in the whole thing I would focus on, because I think it has a nice linkage, jolts, quits, I think, is a very important piece of the overall picture, because quits are people moving themselves out of the labor market. And when they move themselves out of the labor market, that moment creates tightness. And what brings you back in after you quit? Well, what typically brings you back in after you quit is an elevated wage, right? You're working, you say, this doesn't make sense to me, you quit, right? And what draws you back in is you find a better job, find a better opportunity, et cetera. And so that linkage of quits, the quit rate has not come down that much in the scheme of things. It's not nearly as extreme as it was, during the quiet quitting and mass quit thing. But like, quitting has been elevated for a long time. Even before COVID, quitting was a real, had been elevated. And that's the sort of thing that creates upward pressure on wages. It's pretty amazing, actually. The indicator that looks the best in terms of connecting to wages on a leading basis, on a 3 or 6 month leading basis, is actually the quit rate. And it's still pretty elevated.
So then when we look at the JOLTS report in general, and we look at like the number of open jobs, for example, we had around 11.5 million open jobs at some point. That was the peak. And now we're sort of around the 9.5 million range. Is that something that's positive for the economy? Does that show that in case there is an economic downturn, there's some positions that, that are open to get filled? Or do those jobs, the number of open jobs decrease because those jobs are no longer available because they're just not being offered?
Yeah. I mean, job openings has got mentioned by Chairman Powell last year, and we then all sort of rolled up our sleeves and looked at the series that we had largely never looked at before. It's a series and frankly a measurement that it's a little goofy. There's a variety of reasons why that is. One of the primary reasons is that often white collar employers will post jobs as a fishing expedition to try and get talent, particularly in tight labor markets. And so you might see more extreme measures of job openings than sort of the reality. Like, they wouldn't actually hire all of those people. It's just that they're trying to catch 1 out of 10. And so those job opening numbers are, have that problem. I actually like to look at in the NFIB, now we'll get a little weedy in this, but NFIB, which is a small business survey. It's an excellent survey, comes out once a month. It has great charts, good diverse information about small businesses in America, which represent about 50% of employment. So this is a big swath of the economy that's rarely talked about, because most of the time we're talking about what's going on with earnings and S&P 500 and stuff like that. But the economy is driven meaningfully by small businesses, and so what you see in there is that those openings, they're elevated. The current level's a bit above the peak that happened in the previous cycle, but they're not nearly as extreme as what you see in the JOLTS survey. And the reason why that is because if you're running, and I'm sure you appreciate this, if you're running a small business, you don't put out job openings for a fishing expedition. You put out job openings when you need people to do work. Right. And so there's a lot less fluff in them. And I think they're a better indication of where we are in that cycle, which is, there has been some softening. There are fewer openings available than there were during the peak post-COVID moment. But it's still, there's a lot of openings, a lot of people, a lot of demand for labor in the market relative to the labor that people have.
Well, I really appreciate that distinction. I had no idea that small businesses made up 50% of total labor in America. That's actually very interesting.
Yeah, most of us work for small companies, not big companies, and so that's what really that. And I think that people often say, well, the stock market isn't the economy. And that's kind of like a cliche thing to say, but I think it's really there's fundamental reasons why the stock market isn't the economy, and that's because there's lots of the economy, lots and lots of the economy that happens in the non-corporate sector, in the small business sector.
All right, well, softball questions are over. Now
Oh, that
now I'm gonna hit
all
you with
right.
a curveball. If Jerome Powell calls you today, Bob, and says, Bob, what should we do? What are our options here? What options would you provide the Fed?
Yeah, well, I think the biggest thing is that the Fed, if you think about the Fed's tools to slow down asset prices and slow down the economy, they basically have interest rates, and they have something called quantitative tightening. And what quantitative tightening is the Fed has a large stock of bonds that they bought during the post-crisis period and during the COVID period. They bought those bonds in order to inject liquidity into the financial system to support the economy. And they have been reducing their level of bonds in their portfolio, which has been a modest drag on asset prices and economic activity over the course of the last year or so. But the reality is that they're not using it as a flexible monetary tool. Like, they've modestly increased the pace of their sales of assets at a time when they basically increased interest rates as aggressively as they have in 50 years. And one of the things that's important is, if you think about the economy today, it's not really that the price of credit is not really the problem in the economy. The price of credit is not overly stimulative. If you want to go get an auto loan or a mortgage on a house, you're certainly not sitting there going, wow, interest rates are cheap, right? And, interest rates are elevated. There's no question about that. Sure. The problem from a stimulation perspective in the economy is asset prices are too high. And if asset prices are too high, the tool to most effectively bring down asset prices, in some ways it's very commonsensical, is to sell assets, right? If you want to bring down financial asset prices, sell financial assets. And that's what the Fed has at their disposal. And so why they haven't increased the pace of QT, I don't understand. And, trust me, I've said this, very directly, that I don't understand why they don't use the QT lever more significantly. But so far they haven't, and that really would be a much more efficient way to address the liquidity that's in the system.
So if Jerome Powell asks in this next July meeting, should I pull a Jackson Hole and rein the party back in and remind everybody where we are in the cycle, or maybe is there a chance that he's going to buy into the fact that he might be halfway there to orchestrating a soft landing, and he might try to see it through? Is there a chance that that plays in?
Yeah, well, I think I like to say every central banker facing inflationary dynamic is enamored with the soft landing until they aren't, right? Until inflation smacks them in the face. And Jerome Powell, smart guy, certainly very capable, but to be frank, is no different than any of those previous central bankers. If you go back to the January 31st and February 1st meeting, there was an inkling of disinflation in the economy. And Jerome Powell gets up there and he said the word like disinflation in an hour-long, press conference. He said it like 78 times. And then what happened was there was no disinflation. Actually, that got revised out, and the data eventually said any inkling of disinflation wasn't there, and he had egg on his face about that. I think we're probably going to see a similar situation. Now, to be clear, the Fed is going to tighten 25 basis points because it's priced in, and that's what's expected. And so I don't think it'll affect their immediate monetary policy. But my guess is we'll see a loose Chairman Powell the way we did on February 1st. And that may be too confident given the challenges he'll face. But that really is reflective of what most central bankers are trying to do in this circumstance, which is, look, if Chairman Powell can deliver a soft landing, great, that would be the best possible outcome. It is an improbable outcome, but it is the best outcome, right? And so I think this idea of saying that the central bankers will try to get there, will pursue that strategy until to the point they recognize that they can't do it, and then they recognize that really the only path is either unacceptable inflation or a hard landing to bring that inflation down. That's where they get to, but that takes years, right?
Sure.
That can often take years. And how far are we in here? We're like 2.5 years into this process right now.
I think so this is the only thing I might have to disagree with, which is if Powell's not willing to raise rates with 4.2% CPI prints, is he likely to raise rates with a 3% CPI print? I mean, maybe you could shed some light on that.
Yeah, I mean, he's likely to raise he's likely to raise it 25 basis points because we all this is kind of how the Fed works, is kind of everyone is priced in that they're going to tighten interest rate 25 basis points. And so like the Fed, particularly this Fed, this sort of more modern Fed, is not really in a position. They don't go against the market in a particular meeting. They don't really shock the market in that way, in a way that, it used to be fun. Fed meetings used to be fun because there used to be ambiguity about whether there was going to be tightening or easing and how much and stuff like that. And now they're kind of boring, and we have to wait for the show in the press conference and wait for everybody's questions. And so I think more of the question is what's likely to transpire through the end of the year. Are they going to continue to tighten? They said it not that long ago in the SEP that they were going to tighten a couple times through the end of the year. Are we going to see signs that that's changing? My guess is we'll see some communication aligned with the fact that they don't think that they'll need to tighten as much as maybe they thought they had to at the last SEP. But that's really what I would be keeping my eye out for and my ear out for, is I'm sure there'll be very specific questions related to that, and how Chairman Powell answers that will be particularly telling about the path in the second half of the year.
For sure. I think this is going to be one of the more important Fed meetings, just to basically give the markets the clarity whether we're out of the storm and whether the party's back on, or whether he's okay, we're not in the clear yet, cops are still outside, turn the music.
Right, exactly. But is he still hell bent on taking away the punch bowl, or are we off the party a little bit?
Is he sneaking flax under his arm while the cops are outside? So
that's right.
You mentioned there's probably two more topics we have, and then I really appreciate your time here, Bob.
Yeah, of course.
You said on Twitter, because I do follow your Twitter pretty closely, that we're putting too much emphasis on the ISM surveys, not enough emphasis on the Beige Book. Could you give a quick background on Beige Book? Why?
Now we're getting into the real. I love a good convo about surveys. So, the ISM survey, for those of you who are not macro data nerds, is a monthly survey. It's broken into two different pieces. One piece surveys manufacturers and the manufacturing part of the economy. The other survey is non-manufacturing, which is essentially services, the service side of the economy. And those surveys basically go to people and basically say, are things getting better or are things getting worse? Those surveys, when you look through time, back in the 60s and 70s and 80s, were very good surveys, gave very good indications of what was transpiring with the economy. There's been a meaningful deterioration in the quality of those surveys. While the reason for over the course of the last post GFC, while there's a lot of ambiguity about why exactly that's the case, academic researchers have pointed to the fact that there's that partisan views may be influencing survey respondents. And so the simple example is if your party is in power, you'll probably, and things are good, you'll probably report in line with the reality. But if your party is not in power, you're likely to underreport the goodness of what's going on in the economy or in your experience. And that partisanship appears to have been getting worse over the course of the last 20 years. So that may be a reason why those surveys don't work. The Beige Book, on the other hand, it's a survey. It's not a survey in the same sense where they're surveying people, they're calling people up and asking them what's going on. It's a survey in the sense of it's a review of the landscape of activity. And actually how it's constructed is, in the US, the Federal Reserve System has a series of banks in different geographic locations. What they do is they actually have contacts, manufacturing, services, business contacts that they go to. They say, how's your business going? Is it getting better? Is it getting worse? It's a very rigorous and comprehensive study of what's going on in the economy. And so it provides a more comprehensive view and frankly, a more accurate view, because it is focused in many cases on looking at the actual activity, not sort of the sentiment, which the ISM surveys often do. And so the Beige Book also, just for what it's worth, is an input into the Fed meeting. So like, what is in the Beige Book? Literally, the Fed governors are going to open that, and they are going to read that, and they are going to look at the economy through that lens. That's the purpose of it. And so that's a very important consideration if you're thinking about what inputs they're getting to help them make the decisions that they're making in monetary policy.
Yeah, that's kind of, so this is going to sound like a very naive question. I might piss off a lot of economists doing this, but because it's no surprise. I mean, big shocker, bureaucratic institutions are biased. This is, this might be a shock to a lot of folks. But I've always noticed that economic data that relies on surveys can't possibly be as accurate as a real-time tracking system. Now, obviously, you can't speak on the internal stuff at Bridgewater, but I'm assuming that there are more complex models and a little bit more accurate models that some of these private firms are running to track real-time data that might be more accurate than surveys. Is that what the Fed is considering, or am I looking at this wrong?
Yeah. Well, what I'd say is, you can think about sentiment. I would divide the world into sentiment surveys, which is like, ask someone, hey, how's it going for you? Where a lot of those other considerations may influence one's response, which is different from activity sampling. And so the Fed the Bureau of Labor Statistics, and other government agencies, a lot of their stats are based on sampling. And so as an example, the employment report, I mean, just think about it. Like, what happens is the employment report comes out like 5 business days after the end of the month. Well, like, how could they possibly do it 5 business days after the end of the month? They don't have everyone's employment data. They have a sampling of the employment data, and then they make statistical interpretations based upon that sample. And for employment, as an example, what they then do 3 quarters later is they actually get something called a QCEW, where they actually get a comprehensive view. They get 98% of payroll payments, because anytime you pay someone, you have to pay into the insurance funds. And so they actually track the insurance fund payments in order to comprehensively understand employment. And so, of course, the initial employment report is like wrong all the time, has lots of errors because there's this sampling issue. But over time, they sort of true it up and get a comprehensive picture. And so the real thing on these measures is, as you get closer and closer to comprehensive sampling, you get a better and better and more accurate read on what's going on in the economy. And so some of these private firms, like the classic example is like looking at all the oil tankers in the world and seeing where they're going. Well, if you want to measure oil trade, like, if you can actually see every tanker in the world, you don't have to sample. You can just look at them and sum them up, and that tells you what's going on. And so, of course, that's a better measure than just looking at, a sampling of whatever boats are coming into the port of Long Beach or whatever it is.
It's funny that you mentioned the labor report, because that's what I was going to point to, is that the ADP labor report, they have a decently accurate sample because they do deal with a lot of the payroll and they are that main system. But the ADP number has been dramatically off just about every
single.
So is that a sampling error? Does that speak to sampling, or does that speak to the specific methodology that they're using to sample or to put this data together?
Well, anytime you're looking at any let's call it independent data, which ADP is essentially independent from government agency data, it's important to just look at that data relative to the benchmark, right? And the benchmark in the US case is the QCEW, which is, a 90, as I said, like a essentially totally comprehensive view of payroll in the United States. And so, so when you look at that, what you find is that whatever the heck the ADP is doing with their payroll system and their measurement, it's not matching the QCEW. So what are they doing? I don't have a clue. That it's funny. ADP came out, started like 20 years ago, and like was one of my first like macro projects, was like, well, can we infer what's going on with the employment report using ADP? And even back then I was like, nah, it looks random. And then, you know, it's like 20 years later and it's like, yeah, it looks
Nothing's changed at
random.
all.
And the funny thing is they have refactored the estimate to improve the back history maybe 10 times in the intervening period. And every time back history looks great, and then the data comes out, it's totally crazy. So anyway, long story short, you probably shouldn't pay that much attention to the ADP report, because I don't know what the hell they're doing, but their survey sucks.
Breaking news. All right, and now the hardest question of all, Bob.
Okay.
What is your beef with Andy Constant?
Oh, what's my beef with Andy Constant? Well, Andy and I go way back. I tell you, this is, I think, you know, Andy has had more experiences in more of the highest level financial institutions in the U.S. than probably anyone I've ever run into, and more success related to that. I think one of the things that I think really Andy and I got to know each other actually at Bridgewater when I was responsible for teaching the introductory investment associate course. Andy had just started at Bridgewater, and what did he do? He sat right down, you know, with his decades of experience, and took the class and learned, and was a great contributor in that class over the course of a year. And I think that really speaks to who he is, which is, you know, a person who's learning, a person who is growing and learning at heart. And so that's where we got to know each other. It's been fun to go back and forth. You know, I think what he's doing is great. My only bone to pick is him and his damn daily stocks are going up, stocks are going down calls. It's terrible. You know, I can't believe he does. He said he would stop at 100,000, so I'm trying to hold him accountable to stop doing that, because the trolls come out. You can't win any day. I mean, I know you trade technically, and honestly, I couldn't do it in the way that you do it, because for me, any one day, it could be right, could be wrong. There's no way I have any of us macro people. We have no accuracy on that sort of time frame. We have accuracy on, like, you know, 3, 6, 9, 12 months. And so just try and nudge them a little bit to not do that anymore.
Listen, I don't think you're giving yourself enough credit. Well, first off, it's nice to see that you have so many nice things to say, because that's not what he said about you at all. All right?
Oh!
No, all jokes. I haven't spoken with Andy at all. I haven't spoken with Andy. Bob, I appreciate your time. Technical trading is a lot easier. You find an edge, something that is more likely to happen than not. And then your job is to consistently apply that over time without convincing yourself that you're smarter than you actually are. That last part is tougher than it sounds.
I know. The discipline has got to be tough. I mean, I feel like maybe that's what I should do. Forget this macro stuff. That sounds like the way to go.
You clearly, it's obviously been working for you, Bob. So maybe you're doing something right. Thank you for your time. Really appreciate you. And I really can't wait to watch this back. Tons of gems. Thanks for stopping by, Bob.
Thanks for having me. It was great.